When it comes to saving for a successful retirement, obviously it's important how much you're saving throughout the month and year. But let me tell you what's just as important. Where you're saving. Where you're saving your money is just as important as how much you're saving. Today, I want to show you how the most successful retirees and investors are positioning their wealth to disinherit Uncle Sam and keep their wealth via taxes. Keep it right here. Good day, everybody. Chris Heerlein here, CEO of REAP Financial, host of Retire Ready TV on KXAN, and host of Wealth Radio every Saturday, 11 a.m. on News Radio KLBJ here in Austin. Thanks for making us part of your day and tuning into our channel. If you like what you see, hit the subscribe button down below. Okay, after-tax investment returns, that's what matters. But few investors take key steps that could help them minimize the taxes on their portfolio returns. Now, you can find research from the Schwab Center for Financial Research, Morningstar, AQR Research, and others, and what they all show is that taxes are one of the main determinations of the investor's bottom line. And a major factor in increasing your after-tax returns is to have assets spread out, have assets in the right accounts. In other words, maximize after-tax returns by first choosing your investments and then optimizing where you're holding those investments. Most investors, you have several types of accounts, and each of these have different types of tax effects. You have taxable accounts. These are regular accounts at brokerages where you're holding your stocks or mutual funds, and interest and short-term capital gains earned on these accounts are taxed as ordinary income. And long-term capital gains, these things are taxed at more favorable cap gains rate, like even qualified dividends. Maybe you're paying 15 at the top 20%, and generally that's going to be lower tax rates for taxpayers than those of you in higher income tax brackets. Now, interest earned on state and local government bonds and some other types of income, those are tax-free in taxable accounts. Tax-deferred accounts, things like IRAs, 401ks, annuities, and other type of accounts. All of the investment earnings in these type of accounts, they're compounding tax-free within the account. But when you go to pull the money out, it's going to be taxed as ordinary income when it's distributed. Now, tax-free accounts, that's where it's at, right? These include like Roth IRAs, Roth 401ks, health savings accounts. Those are the type of accounts that can give you more control. The investment earnings in these type of accounts, they compound tax-free. And when they are distributed, they come out tax-free. So you maximize after-tax returns by holding assets in the most tax-efficient accounts. Now, the priority is choosing the right asset. Choose the right allocation for you. Everybody's different. Then, to the extent you can, based on how much money you have in each of the different accounts, hold each investment in the type of account that's optimal for you. But you don't simply have to change your investment. Investment choices simply are the investment itself. It's not the tax designation. The general rule for optimum asset class and optimum asset allocation, it's pretty simple, but there are some important exceptions that can enhance your after-tax returns. Let's talk about those. The first general rule is that investments that have their own tax advantages should be held in taxable accounts. Bonds that generate tax-free interest should be in your taxable accounts. Qualified dividends, which are dividends that are paid on most stocks by US-based companies, that has a tax advantage. Those are taxed at a maximum of a 20% tax rate. Master limited partnerships usually are best held in taxable accounts because they have their own tax benefits and their earnings might be taxable when they're held in IRAs. You think about stocks, exchange-traded funds, and mutual funds. A lot of these are held in taxable accounts when possible because they earn long-term capital gains. And again, that's taxed at a maximum 20% rate when held for at least 1 year. Now, when they're held in taxable accounts, losses can also be deducted against other capital gains. You heard about tax loss harvesting, and up to $3,000 of the capital loss that exceeded the capital gain can be carried forward and deducted each year up to $3,000 against other types of income. Now, tax-deferred accounts should hold investments that generate ordinary income in taxable accounts. Now, when the earnings are distributed from the tax-deferred account, they're taxed as ordinary income anyway. But while they're in the tax-deferred account, they compound tax-deferred to a higher amount than if they were in a taxable account. Things like your IRAs and your 401ks, those things are growing tax-deferred. You're able to put a lot more money in initially because you're getting tax deductions. Okay, so when you think about capital gains taxes versus income tax, this is a big deal because what happens is you effectively convert tax-advantaged investment returns into ordinary income. And that's because all distributions from taxable accounts like IRAs and 401ks are always going to show up on the bottom line as income. Even if they would be tax-favored long-term, like capital gains or preferred dividends, the thing is that they're not going to be as optimal as Roth IRAs. The optimal investment, in our opinion, is the Roth IRA and Roth 401k because in these type of accounts, your money is growing tax deferred just like the other accounts. But the after-tax amount is what's the most important. We see that Roth IRAs can generate the highest returns in your portfolio, not because of the hot stock or the investment that's in it, because every dime that you see in returns is yours. It's off the government books. And distributions from these accounts, particularly in retirement, are tax-free. They come out tax-free. They won't impact your bracket, they won't impact your Medicare premiums, and a lot more. So what you're doing is you're maximizing tax-free income by having the highest returning investments in a tax-free account. So what we generally advise successful families to consider is you think about your risk profile in your investments. You may have conservative, you may have moderately aggressive, and then aggressive. Generally, we want to see your most aggressive investments in the Roth IRAs, Roth 401ks, because we want the most growth potential tax-free. At the end of the day, the most successful retirees out there, they likely don't have money problems, they have tax problems. And generally, you don't identify these issues until you're approaching retirement or already in. For years, we've counseled families on how to be poor on paper. We want millions in the bank, but I want you broke on your tax return. And that's what we can help you do, just as we have so many successful families here in Austin, Texas. I want you to get your hands on our updated 2024 tax retirement guide. It's at no cost for all of our YouTube viewers. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team will have our tax guide in your inbox before you know it. Until then, all the best.